Welcome back, everyone. Today we're diving into Lesson 2, Fibonacci and Waves. If the first lesson was about identifying where we are in the market, today is about how we measure the strength and depth of those moves. We're going to combine the mathematical precision of Fibonacci with the natural rhythm of market waves to build a high probability framework for your entries and exits. Let's get started. First, let's define our toolkit. In trading, Fibonacci isn't just about math. It's a tool to predict psychological reversal points. We look at two main applications, fib retracements and fib extensions. Why does this work? It's because of market dynamics. Markets don't move in straight lines. They move in waves driven by human emotion, fear, greed, and indecision. Every big move eventually needs to catch its breath. Fibonacci allows us to measure exactly where that breather is likely to end and where the next impulsive move begins. Think of the market as a rubber band. When momentum pushes a stock price rapidly upward, you can't expect it to just hang there in the air. It naturally snaps back to catch its breath. This pullback is what we call a retracement. As traders, we don't guess where this pullback ends. We use Fibonacci lines as a psychological ruler. The stretch. This is your trend. Price pulls sharply upward, building tension. The snapback. This is your correction or retracement. The band contracts. The catalyst. This is the release, where price catapults upward again in the direction of the original trend. Again, Fibonacci acts as our main ruler. It tells us if the snapback is just a minor twitch or a total collapse of the trend. Without this ruler, you're just guessing where the floor is. Not all levels are created equal. Here are the heavy hitters. 38.2%. This represents a shallow correction. If the price holds here, you're looking at an extremely strong trend with massive momentum. 50.0%. The psychological midpoint. While not a pure Fibonacci number, the market loves the 50% discount. It's a vital area of interest. 61.8%. The golden ratio. This is the most critical line. If you see a reversal here, it's the highest probability setup in technical analysis. Note that our TI system uses an expanded set of levels beyond these basics to filter out market noise and improve our entry accuracy. Rhythm is everything. We observe that the market moves in a five-wave structure. Price goes up in 5 waves, pulls back in 5 waves, and then continues. This cycle repeats on every time frame, from the 1-minute chart to the monthly. Waves 1, 3, and 5 are your impulsive moves, where the money is made fast. Waves 2 and 4 are corrective. Our goal is to use Fibonacci to measure these pullbacks so we can position ourselves for the meat of the impulsive waves. Let's look at the anatomy of a move. Wave 1 sets the stage. Wave 2 retraces, usually hitting that deep 61.8% to 78.6% zone. Wave 3 is typically the longest and strongest. We use extensions like the 1.618 to 2.0 to target the top of Wave 3. Wave 4 is a shallow breather, often hitting the 38.2% before the final push in Wave 5. By mapping these out, we aren't just reacting to candles. We are following a roadmap. It's one thing to see this on a clean diagram, but how do we actually apply this? Let's move over to how this 5-wave structure is visualized and executed on a live TradingView chart. You pick the Fibo retracement tool and place it at the beginning and end of the wave. For Fibo extension, you place it at point 0, point A, and point B. Wave 1 is the most difficult to spot because it marks a change in direction. It's the 0 point of a new trend. We look for 4 specific triggers. The previous structure must be finished and have reached its fib extension targets. Price is sitting in a major fib retracement zone from a higher time frame. We see a liquidity flip, which we'll cover in lesson 3. And on a smaller time frame, we see an impulsive five-wave move starting to form. When these align, you found the birth of a new trend. To increase our win rate, we look for confluences, multiple signals saying the same thing. Check the previous move. Was it a completed five-wave structure? Look for divergence on MACD and volume. If price is making a new low, but the MACD is rising, the sellers are exhausted. Watch for squatting candles at the peak. These indicate a struggle where the trend is about to flip. Finally, a confirmed change in MACD direction gives us the green light. Wave 2 is where we get ready to strike. It's a corrective wave, often following a five-wave internal structure labeled A, B, C, D, E. While Wave 1 was the change, Wave 2 is the test. We expect a deep correction here, usually between the 61.8% and 87.5% levels. This is the golden zone for entries. We aren't chasing the move, we are waiting for the price to come to us at a discount before the massive Wave 3 takes off. It's important to stay disciplined here. A new structure is only confirmed when Wave 3 breaks beyond the high of Wave 1. Until that break happens, we are still in a probabilistic zone. Before committing to a W2 entry, always look back at the internal structure of Wave 1. We want to see a clear, completed five-wave sequence. This gives us the confidence that W1 wasn't just a random spike, but a genuine impulsive shift in trend. Remember, W2 is your entry window, but the break of W1 is your validation. Now we get to the moneymaker, Wave 3. This is the most impulsive part of the cycle, characterized by the biggest price increase in the shortest amount of time. The volume? You'll see the highest splash of volume here as the rest of the market realizes the trend has shifted. The math? To qualify as a true Wave 3, it must reach a minimum Fibonacci extension of 100%. If it doesn't hit 100%, it's not a W3. Targets? We use the 161.8% and 200% levels as our primary take-profit zones. While you might occasionally see extensions to 261% or beyond, those are rare blow-off moves. Stick to the high-probability targets. Wave 4 is arguably the most deceptive and frustrating phase of the market. It's where most whipsaws and false movements occur. The logic? Because Wave 2 was a deep, sharp correction, Wave 4 is typically shallow, often only hitting the 38.2% to 50% zone. The time factor? Wave 4 can take up to 70% of the entire cycle's time. It's a sideways grind designed to shake out weak hands. The rule of thumb? If you're looking at a chart and can't figure out where you are because the price is moving aimlessly, you're likely in a Wave 4. Patience here is mandatory. We've seen assets like gold stay in a Wave 4 for years. Wave 5 is the final push. It's the last hurrah before a major trend reversal. The targets? We typically look for the 61.8% extension of the move from Wave 0 to Wave 3, projected from the bottom of Wave 4. Pro tip: if Wave 3 was exceptionally strong, over 120%, expect Wave 5 to be a more standard 100% move. Risks: be aware that Wave 5 can sometimes be truncated, meaning it fails to break the high of Wave 3, or it can become a blow-off top if retail FOMO kicks in. Like Wave 1 and 3, it should still contain a smaller five-wave internal structure. Finally, how do we know the party is over? We look for exhaustion. In Wave 5, price often makes a new record high, but the volume and MACD do not. Look at the red lines on the diagram. The price is drifting up, but the momentum is drifting down. This divergence is a massive warning sign. The market is moving on fumes at this point. When you see new highs recorded without volume confirmation, it's time to tighten your stops or exit the building. The cycle is complete, and the larger correction is imminent.